Welcome back to Squawk Box. Rick Santelli here, live at Chicago's CME HQ with breaking news. Initial jobless claims for the week of November 13th. Well, they moved up 1,000 until we get the revision. Last week was 267,000. Right now, the new number is 268,000. And as if on cue, revision to 269,000, which actually makes this 1,000 lower. And it still makes it the post-COVID low by swapping those revisions a little bit. On continuing claims, 2,080,000. 2,080,000, and that usurps a couple of weeks ago when it was 2,101,000 to be the post-COVID low. And revisions to last week moved it from 2,160,000 to 2,209,000. Whew, those are a lot of thousands, huh? And if we look at Philly Fed Index, and this actually might be the most important number of all, it's a November read, expecting 24. Zoom, 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 39. 39. 39 is the highest since April when it was 50.2, and that was a 48-year high. Let's put it another way, Joe. If you look at all of 2019 pre-COVID, the high for Philly was 17.5. I believe it was in May of 2019. So these are really good, strong numbers with regard to Philly. We see interest rates, as you pointed out earlier, hovering right around that 1.60 mark. And I'll tell you, I think the most important news to pay attention to today is twofold. First of all, John Deere strike ending. Why is that important? Holy cow, if you looked at the contract, unbelievable. 10% immediate raise, $8,500 immediate bonus. They get 5% jumps in the odd years. They get 3% jumps in the even years over the next 6 years. And they get incentives of 4% for performance. A juicy contract shows that the biggest cost on anybody's balance sheet is the people that go in and out of the front door every day and go to work. So labor costs going up. I think the other big issue is all of a sudden, you know, there's left, center, and right. We'll leave it at that. But mostly now I'm hearing the left joining the right in this chorus. Don't ignore inflation. Boy, I have a feeling that the Biden's pick is getting awfully close. Back to you, Joe.
Interesting piece in the financial annals today, Rick, about the absence of the bond. It's Becky listening, the bond vigilantes. They on the dust bin of history. They went away with the 8-track tape, but the person that wrote this says that they're not gone. There's just they can't make any money
They didn't
anymore.
go away. You can't fight the Fed.
Yeah, the opportunity used to be they could make money, but not when a Fed is this active and involved. They've been silenced.
They've
been cut off.
What was great about that article, Joe?
What?
What was great about the article is it didn't just talk about the issues with post-COVID. They brought it all the way back to the credit crisis, which is the appropriate thing to have done. We never really reversed some of the issues from the 2007 to 2010 era. Yes, the signals are so cloudy, no matter how thick your glasses get, even Shelley Berman's old glasses, you can't see those signals anymore.
And Steve, I didn't introduce you, but in the rundown,
can I just point out?
It says leaseman data again, which when I look at it quickly, it says lease mania. And I forgot that the lease maniacs do crave to see you. So this is our lease mania.
I know.
Go ahead.
I know. It's absolutely. I just want to point out that the bond, the 10-year bond, had no trouble running from 90 back. I don't know, in the middle of the crisis, back up to 160 over time. I feel like it's the ability of the market to express itself, despite what the Fed is doing, is a little underrated. I think when the market wants to say yields should be higher, it can go higher. Perhaps it's not as amplified or as volatile as it would be if the Fed weren't in the market. But I do think if you go back to, I mean, that's a daily chart. But if you go back a year on that 10-year, yields were down. They were down very low, ridiculously low. And then they came back. Look at that. They came back pretty well, pretty easily. When the market wanted to express itself that way. So I think you got to be a little careful thinking that the market can't do this. The Fed is in there. It's buying in substance. And by the way, the Fed has said it's coming back out. And you've had this very modest rise in the 10-year. So I'm curious as to why that would be if the Fed is seen so depressing the 10-year yield and its ability to express its concern about inflation. So, Steve, would you say the price discovery is still okay? And, Rick, you probably don't really believe that the price discovery mechanism is really working. Is that the point you're making? Are you guys
on different sides of this? I hope not. I'd hate to see you guys go at it.
Yes, we're on different sides, Joe. The price discovery process is broken. I don't think it'll ever be fixed. But he is right. There is a pulse there. The problem is that the body is in no condition to get up off the table and actually do any strenuous exercising.